The Strategy CEO recently put $250,000 of his own money into a single investment, not Bitcoin, not MicroStrategy stock, a preferred security called STRC, paying 11.5% annually in monthly cash dividends. He said publicly that he is using those monthly payments to cover his mortgage, and when the CEO of the company that issues the investment is putting his own money into it and using the income to pay his bills, people pay attention. Today we are asking the questions that matter. What exactly is STRC? How does it actually work? What are the real risks that nobody is talking about clearly enough? And does it actually deserve a place in your income portfolio? To answer those questions, we sat down with David Shikansky, CEO and founder of Quantify Funds and one of the most thoughtful voices in the alternative income investing space right now. And full disclosure, David has over 6 figures of his own money in STRC. He has skin in the game. And he is also the person who shorted MicroStrategy stock in December 2024 when it was trading at 3 times its Bitcoin value. This is not a promotional conversation, this is a real analytical breakdown. Let us get into it. Welcome back to the Dividend Desk, where we build income strategies for real life. Before we go any further, this content is for educational and informational purposes only. It is not financial advice. I am not a financial advisor. All investments carry risk, including the potential loss of your capital. Please always do your own research and consult a qualified financial professional before making any investment decisions. Now let us start with the most important question first. What exactly is STRC and why is it generating so much attention right now? STRC is the ticker for Stretch, Strategy's perpetual preferred stock, and to understand what that means, you need to understand what a preferred security actually is. A preferred security is a hybrid instrument that sits somewhere between a common stock and a bond. It has a higher income payment than typical common stocks. And in the event that something goes wrong with the company, it has preference over common shareholders, meaning preferred holders get paid before equity holders in a liquidation scenario, so it is not as risky as owning the common stock outright, but it is not as safe as owning a traditional bond either. It sits in between. And what makes STRC specifically different from any other preferred security on the market right now is that it is a variable preferred, a concept that has genuinely never existed in the preferred securities market before. Here is how the mechanism works. STRC targets a price of $100 per share. If the price rises above that target, say to $101, Strategy will start trimming the monthly distribution to bring demand back down and push the price back toward that $100 peg. If the price falls below that target, say to $98 or $95, Strategy will increase the monthly distribution to incentivize buyers back into the market and pull the price back up to $100. The result is a preferred security that is designed to trade with almost no price volatility, hovering consistently near that $100 level, while the yield itself floats up and down in response to market conditions. Right now that yield is sitting at 11.5% annually, paid out in monthly cash distributions. And those distributions are classified as 100% return of capital, which, as we have discussed on this channel before, means they are not taxed in the year you receive them. They reduce your cost basis instead, deferring the tax liability into the future. Now, before we go any further, we need to address the question that is on everyone's mind when they first encounter a number like 11.5%. Yung standikan I dermbo perstanad stofersten. Standrastaninen, where does the money actually come from? Because unlike a dividend stock like Coca-Cola, where the dividend is funded by actual company earnings, or a covered call ETF where the income is generated by option premiums, Strategy does not have traditional revenues paying for these distributions. What Strategy does have is a balance sheet full of Bitcoin and a significant cash reserve that they have specifically set aside to fund these preferred payments. Every time STRC issues new shares and raises capital from investors, Strategy takes that money and uses a portion of it to buy more Bitcoin. The rest goes into a cash reserve designed to cover at least 2 years of distribution payments across all their preferred securities. So, the cash that pays your monthly distribution right now is coming from that reserve. Not from business revenues, not from selling Bitcoin today, but from pre-allocated cash on the balance sheet. So, let us talk about the risk directly because this is where the conversation gets genuinely important and where a lot of the noise in the market around STRC gets it wrong. David rates the risk of STRC at about a 3 or 4 out of 10, not a 1. This is absolutely not a risk-free investment, but not a 7 or 8 either. The risk is very specific and very well defined. The scenario in which STRC becomes genuinely problematic is this: Bitcoin falls substantially and then stays down for an extended period of time. The specific number David and his team have modeled is Bitcoin dropping to approximately $35,000 and remaining at or below that level for a full 2-year period. At that point, the cash reserve strategy has set aside would be depleted. They would have to begin selling actual Bitcoin to continue making distribution payments on STRC and their other preferred securities. And that is the scenario in which the investment thesis begins to break down. But here is the key question: how likely is that scenario? Strategy has publicly stated that they need Bitcoin to compound at a 2% annual rate to maintain their current obligations. 2%. When you consider that Bitcoin has historically compounded at dramatically higher rates than that over almost every multi-year period in its existence, the bar for the investment to work is actually quite low. David puts it simply: if you believe that Bitcoin will not fall to $35,000 and stay there for 2 consecutive years, then STRC represents a genuinely attractive source of income. The analogy David uses to describe the position is one of the clearest framings of STRC we have heard. He describes it as selling insurance on Bitcoin's price. When you own STRC, you are essentially saying, I am willing to accept 11.5% per year in monthly income in exchange for taking on the risk that Bitcoin could fall severely and stay down for a long time. If Bitcoin stays above that critical threshold, you collect your premium every month. Now, the tax treatment of STRC is another dimension that makes it particularly interesting for income-focused investors, especially those in retirement accounts. David notes he has a higher allocation to STRC in his retirement accounts specifically for this reason. One of the most fascinating aspects of STRC right now is the volume story. In the days leading up to the ex-dividend date, trading volume on STRC has been extraordinary. We're talking about 9 million shares traded in a single day at a $100 share price. That is $900 million in a single trading session. For investors who are worried this sounds too good to be true, David addresses the criticism head-on. Some commentators have described STRC as a Ponzi scheme. His rebuttal is clear and worth understanding. A Ponzi scheme is a fraudulent structure where returns for existing investors are paid using new investor money with no underlying asset generating real value. STRC is not that. There is a real underlying asset, Bitcoin, sitting on Strategy's balance sheet. There is a real cash reserve specifically allocated to make payments. One of the most interesting forward-looking points David makes is about the distribution rate itself. He is quite direct. He does not expect 11.5% to last forever. His view is that over the next 12 to 24 months, the rate could eventually settle somewhere in the 7 to 9% range as the market more accurately prices the risk. His advice: enjoy the 11.5% while it lasts. As always, do your own research. Understand what you own. Understand the risk. Make sure it fits your goals, your timeline, and your overall financial plan. But the conversation around STRC is happening and it is worth being informed. Drop a comment below telling us whether you're already holding STRC, considering it, or staying on the sidelines and why. We read every single one. Hit the like button if this breakdown was useful and subscribe so you do not miss our next deep dive. We will see you at the next one.